Welcome everybody to our real estate webinar series. Today we're going to be talking valuations. We have the fabulous Tim Tukulski and Carolyn Silland to go ahead and run you through this topic, and they could talk about this all day long, but we're going to try to keep it into a 50-minute window, and we'll be able to take questions throughout. We are going to be a smaller group this morning. We're under 50, so we can have a big conversational. So go ahead and put all of your questions in the Q&A box. We've disabled chat so that we can stream all the questions into one area. So if you can go ahead and plug any questions you have into Q&A, and either Tim or Carolyn will definitely give you answers. We are recording today's presentation, and you will get a copy of the recording as well as a copy of the slide deck later this afternoon. You'll be getting email from me with all of those goodies in it. So without further ado, I'm going to pass it on over to Tim.
Well, good morning, everybody. It's a pleasure to be with you this morning. So we are going to, as Jennifer said, have a conversation about valuations and try to take the mystery out of what the process of valuation is. I'm going to talk for a few minutes in the beginning about why this is important at this point in time. Obviously, estate planning is a huge opportunity because of the change in administration. There will be some changes coming for sure. We don't know exactly what those changes will be, but we do have an indication of what Biden wants to do in the administration. So we're going to talk about that. And then we'll talk about techniques that we use, have been using, and will continue to use in this transition. I'd like to give, obviously, the standard disclaimer in the beginning of this is that, please, this is for informational purposes only. And if you are going to proceed with the transaction, please, please, please seek the advice of your attorney or accountant. And if we are that, then great, you're halfway there, okay? So I'm going to be introducing Carolyn Silland. So I've worked with Carolyn for almost 20 years now. She, in addition to being a senior tax manager, does have a specialty in valuations. She's both an ABV and a CVA. So she has been instrumental in assisting my clients with various valuation engagements, not exclusively in estate planning, but primarily that is where I've used her in many respects. I myself am a CPA. I've just celebrated my 40th tax season. I'm also a certified commercial investment member, CCIM. I focus primarily on real estate and real estate transactions. I've done that now most exclusively for almost 25 years. So I attempt to answer the question, or actually I like to say that I don't have trouble convincing my real estate clients that real estate is a good investment, but I have trouble convincing them it's not the only investment. So I spend a lot of time talking to clients about complicated 1031 exchanges, tax planning, but then also talking about whether or not their investment makes sense from a personal financial planning and whether they should be diversifying their portfolio. So today, again, we'll make this conversational. We do have an agenda that we're going to follow, but if you have questions that come to mind that are relevant to the rest of the group and on topic, happy to answer those live. If we feel that those questions might be beyond the scope of or interest of the rest of the group, then you certainly have our contact information. We will follow up with those questions on a one-on-one. So kicking this off, I just want to make a case for why we're talking about valuations and why we're talking about estate planning. So as you probably know or heard, and if you don't, you will know, that individuals can give up to $11.7 million of their property away during life or at death and be free of estate tax. So maybe you know that when you die, the value of your property is all your property is valued on the date of death. And if that value of that property exceeds the annual exclusion and or the unified credit amount of $11.7 million, then you will be subject to a 40% estate tax, or your heirs will. So that exemption amount is scheduled to go down to $5 million adjusted for inflation. As you can see from this slide, this gives you a history of that exemption amount. You know, I started my career in 1980, and this slide doesn't go quite back that far, but I do recall when the exemption amount was below $1 million. It was around 600,000 actually years prior to 2001. Interesting little perspective, you can see that in 2010, the exemption went to zero. Why? Because actually the estate tax was completely eliminated in 2010. And it actually was a situation where if you were to make a gift or on death, your gain, a built-in gain on the property was actually recognized. So the good news about the exemption amount, obviously because it's large, is that you have the ability to transfer a lot of wealth below that exemption amount and still, at least under today's law, receive a stepped-up basis in the property that's transferred. And that's regardless of whether your estate paid a tax or not. Biden has said he doesn't like that. He wants to see either no step up in basis on death or on gift, and has actually proposed, we don't know how sticky this will be, but he has actually made a proposal to tax gifts or transfers on the date of death. In other words, if I were to give a property that I bought 15 years ago for $100,000 and give that today or at death to a beneficiary with a value of $1 million, I would have a $900,000 capital gain that I'd have to report on that gift. So we're obviously closely monitoring that proposal, and he's going to have to get that through Congress. Might have a lot of pushback, but certainly the exemption amount, the ability to give away property at life or at death, scheduled to go down 2026 with a inflation adjustment of 6.3. He wants to reduce that even further, possibly proposal down to 3.5 million. So the call to action, quite honestly, is we need to be talking to our clients about transferring that property now and taking advantage of this $11.7 million exemption. And that's what we're going to talk about. So let me go through in a simple example just to kind of drive this home. Mom has $12 million worth of assets today. And, you know, it could be a mix of assets. It could be, stocks, bonds. It could be real estate. Primarily, usually it is. That's usually the biggest asset. And it's all held in her living trust. And living trust just simply says that that's acting as her will. So that property will go on death in accordance with her living trust, which is revocable. On her death, all the assets, according to living trust, will go to her daughter. Now, if mom dies in 2026, where the exemption is $5.49 million adjusted for inflation, then mom's estate will actually pay $2.6 million in estate tax without any planning. Now, the good news, if there's any good news in that, is that the daughter will receive those assets with a stepped up basis of $12 million. So if she were to go out the next day and sell that property for the fair market value, she would not have a gain. Now let's just change this up a little bit and say, well, I attended this seminar. I think that we need to do some planning here. Can we give away and utilize the $11.7 million exemption today such that we won't have that big tax bill in 2026? And the answer is yes. With proper planning, you could do that. Now, of course, we don't want to make mom a pauper, right? This is a very simple example. So if you were to give away $11.7 million, what's she going to live on? Well, we have strategies to accommodate that. But let's just go through the example. If mom were to do that gift today of 11.7 and then die in 2026, she would have no exemption in 2026, even though it was $5 million, because she utilized it with the $11.7 million gift. You know, the estate tax, by the way, is an accumulative transfer. So if you gave gifts in the past, those gifts are still counted towards your exemption amount. But the beauty of doing the gift today is there's no clawback of the excess, the 11.7, over the current exemption in the year of death. So there is no risk, unless you didn't do the planning correctly, that any of this 11.7 will be brought back into the estate. So with this simple example, the estate is going to save $2.4 million. And that assumes no appreciation in mom's assets. So again, not only are we transferring out the wealth today, but we're also transferring the appreciation of that wealth after the gift. And that's a huge advantage. So what we're going to do is I'm going to pass it on to Carolyn, who's now going to talk about the valuation process. Just to kind of, again, take out the mystery of valuations. So again, as I said, you know, your assets are valued on date of death. How do you value? Who comes up with the value? Well, you, the taxpayer, must prove to the IRS what that value is. So in my simple example, if we say that 12, you know, that 11 or 12 million that she had was residential or commercial property, how would you determine the value? So Carolyn, do you want to kind of just take us through the steps of the valuation process?
Sure. Okay. So business valuation, it's a process of determining the current value of a business as at 100% or at a fractional interest. And to start the process, we need to know the purpose of the valuation, because that'll determine which standard we're going to use for the valuation analysis. And obviously, we need to know the size of the subject interest. Next, please. Yeah. And there we perform business valuation for a variety of reasons, and I put them into two groups. The first one is the non-tax valuations. We typically would perform valuation for mergers and acquisitions, buy-sell agreement, litigation support, divorce, etc. And the next group will be tax reporting valuation. If someone passes away, we need to know the value of his interest in the business for filing 706. That's the time we need to perform a valuation. Also for estate and gift planning, ESOPs are one of them, and very often we perform valuation for to determine the built-in gain when making an S selection. And there are different standards of value. For tax reporting valuation, it is required to use fair market value. And fair market value is determined by IRS. I'll be on the next slide. The IRS says, next slide, please. Yeah. The fair market value is the price at which the property would change hands between a willing buyer and a willing seller. This is from the IRS, and also in the international valuation community. On the next slide, we also emphasize it needs to be a hypothetical willing buyer and a hypothetical willing seller. Okay, and this is the summary of the valuation process. Once we know the purpose, we know the which standard to apply, and there are a few key things we need to determine right away. Go on, next slide, please. Probably 2 slides down. The next one, yeah, here. We need to know what the valuation date is. We are trying to determine value of a company at a specific point in time. So there might be subsequent events that would change the value of the company. Do we need to consider those subsequent events? It really depends on whether those events were known or knowable on the valuation date. And one current example is if we were going to value a company with the valuation date, December 2019, well, we consider it will be inappropriate to consider the impact of COVID-19 that took place in 2020. And before COVID-19, one very extreme example is 9/11. I think that happened almost 20 years ago. Yeah, if we're going to value a company in New York City on September 10th, it would be inappropriate to consider what happened next day. So that's the concept of knowing the valuation date and the events that happen after the date. And the next one is to know your subject interest. Could you go back, please? Yeah, your subject interest. Obviously, we need to know the size of the subject interest, the characteristics of the interest, what type of control does it have, or does it have any control? And marketability, you'll be saying, one might be saying, we're talking about privately held business. Of course, there's no market out there for privately held business interest. But there's one exception out there, which is ESOP. Because in the ESOP case, the company or the trust is required to buy back the shares or the interest. So the marketability in the ESOP situation might be a little different than the closely held business.
Well, Carolyn, in the context of a real estate holding company, are some of these steps, can we shortcut some of these steps? Because we don't have an operating business per se. We have real estate as the major asset. So I believe that what you're doing is you're taking your valuation based on an appraisal of the real estate. Is that correct?
That is correct. That's the starting point for a real estate holding company. We need to have an appraisal report from appraiser. We'll start from there, yes.
And we don't, just for full disclosure, we don't do real estate appraisals. So that is an extra cost associated with doing a valuation of a real estate holding company if that property is held in an entity, which we'll talk about later. Did you want to make any other comments on the valuation process? Yes? Oh yeah, there we go.
There you go, here. So now we are into we collect all the information there, and now we're into the part we're dealing with numbers. So there are many different ways to measure a company value, and basically they could be grouped into 3 approaches: assets, market, and income. An asset approach is appropriate for asset-intensive companies, and real estate holding company will be one of them. Basically, we adjust the value of the assets and liabilities, to their current market value. And for market approach, well, ideally, if you could find a public traded company that does exactly what you're doing, there's already a stock price out there, and that'll be a very good starting point to measure your company value. But in reality, it's almost impossible to find one. Then we'll go to, if public company doesn't work out, we'll go to mergers and acquisition. These are the databases, records from business brokers and banks. And for real estate holding companies, we'll go to the database of public traded partnerships and REITs. And the third approach is the income approach. Income approach, this is a must for an operating company. Obviously, if you're investing in a operating company, the value of an operating company is from its ability of generating profits. However, for a real estate holding company, we'll look at the income approach as well, but most of the time we'll end up using asset approach and market approach only.
So I often get pushback from clients on valuations when they say, well, first of all, why are they so complicated? Why is it so expensive? And I think what this slide illustrates, and if I'm correct, that you just can't necessarily pick and choose one of these approaches and disregard the other two without, professional judgment. So in a sense, what you're doing, Carolyn, if I understand, is you're looking at all three of these approaches and methods and calculating what the value might be or the range of values given under all these approaches. And then with your professional judgment, deciding which one is most appropriate in the situation. Is that correct?
That is correct. Actually, for tax reporting valuation, the IRS actually requires us to consider all three approaches. Yeah, when they need to be considered, if it's not appropriate, then we'll exclude from the final conclusion. But all three approaches needs to be looked at.
So as Carolyn mentioned, the income approach, which is required, wouldn't necessarily be appropriate in a pure real estate holding venture because net operating income of the real estate already drives value. I mean, that is really a key toward that. Now, it may be not an appropriate value because the income might be low. Maybe it's a below market rent, or maybe it's too high because it's related to a related party transaction. A lot of my clients, buy the real estate and lease it to their closely held business and might have a tendency to either, overcharge rent or undercharge rent, depending on the tax situation. So there are situations, Carolyn, if I'm aware of, that you would actually have to normalize earnings based on those type of factors, correct?
Yes, that's one of the steps, especially we're valuing in a operating company. We actually have to go through the P&L, the profit and loss statement, and kind of look at the key items. Typically, that include the owner's officer's compensation, rent, or any one-time charge or income that will need to be excluded from the analysis.
Right. So that gets us to the overall enterprise value of the particular entity that you're valuing. But we're not done yet at that point, are we?
No, we're not done yet. Yes, at that point, we will come up with the 100% value of a company. But what if we're dealing with fractional interest? There are more adjustments need to be done for a fractional interest. And discounts for lack of control and discount for a lack of marketability. Actually, I want to remind you, IRS doesn't like the word discount. So you will see a lot of hope you refer them to as adjustment for a lack of control or adjustment for a lack of marketability. Yeah. And let's talk about control first. Yeah. If you're going to buy 5% of interest in a company, will you be willing to pay 5% of the enterprise value? It really depends, right? Depends on what type of control that 5% has, what type of rights that 5% has. Typically, 5% is a minority interest. It probably doesn't have any rights to participate in management or decision making. It has no right or no say in who to hire, how much to pay, the salaries wise, or what assets to buy or to sell, and dividend distribution policy. That's one thing that most investors will be really concerned about. Yeah, and without all these rights, how do you, as a business owner, how do you make that investment attractive to the investor? You will reduce the price. Yeah, so the adjustment for lack of control is a reduction, is an adjustment in the value to compensate the lack of ability to exercise the control in the company. So that's the first one. And the second one, we'll look at the marketability. Marketability is ability to quickly convert investment to cash. So if you have $100,000 to invest today, would you be willing to invest in a stock market or a privately held business? With the stock market, you can turn around, you probably turn into cash in a couple of days. But with the privately held business, it might be taking months and weeks and months, and it's just very inconvenient. So would you be willing to invest in a privately held business? Maybe if the price is right, if it still gives you the rate of return you're looking for, so you may be willing to invest in the privately held business. And how do we do that? You lower the purchase price. So this is an adjustment to compensate the inability to change or convert the investment to cash quickly.
So Carolyn, tying this back to my very simple example of mom owned $12 million of assets, you know, let's just assume that mom didn't have a business. I mean, she's got, you know, again, a stock portfolio. She may have some personal assets. She has a 100% ownership in a commercial property or a multifamily property. How would we avail ourselves of discounts? I mean, how is mom giving away fractional interests in all those activities?
That'll be perfect for my next slide. Okay, so family limited partnership, that is a very popular tool for estate planning, one of the popular tools for estate planning. And parents would like to share their wealth with their children or grandchildren, but also at the same time, they want to preserve the control. They want to have the control over the properties and centralize the management. And this is how you do it. You will contribute your assets into this form of partnership and contribute all of your assets into it. So instead of giving pieces of assets or properties to your children, you will be giving them a fractional interest in the limited partnership. Right
So
there.
if we were to put, say, mom's pool of assets, $12 million, into and I'm assuming this is done as a partnership or a flow-through entity. I think we could be an LLC.
Right.
So the initial transfer of that 12 million in assets to an entity that's 100% controlled by her is not a taxable event. So there we go. I mean, we've set up an entity. And now, rather than giving fractional interest in each piece of those assets, we're giving a fractional interest in what? The interest in the partnership itself?
That is correct. Yeah, you will give the partnership interest instead of the actual assets, pieces of assets. And because the purpose of a family limited partnership is to keep the family assets together within the family. So the partnership agreement usually has various restrictions to prevent one from selling the interest or transfer the interest to someone outside the family. Yeah.
And those restrictions translate into adjustments or discounts.
Definitely, they will drive up the adjustment for lack of marketability and lack of control as well.
So obviously I'm baiting the questions here, but if the goal was to drive the value of that fractional interest down, the more restrictions that we put, the better in the operating agreement of the partnership. Don't we run the risk, though, that if we put too many restrictions in there, the IRS might consider that we never transferred the property in the first place, and therefore we don't have a completed gift?
Well, certainly that's something you want to review the agreement closely with the attorney. Mm-hmm. Just make sure they're appropriate. Yeah. Right. Because the goal is not to drive up the discounts. The goal is to keep the assets within the family. Right.
Yes. So avoid the use of the term discount. And stick with what is the goals and objectives of the family. And I think that you're going to have to, mom and dad are going to have to understand that there is going to be an element of control that is given up. It wouldn't be proper to set one of these up and not have the economics change with respect to mom and dad. I mean, you can certainly do that. A partnership agreement can be written almost in any way where it restricts the ability for limited partners to get cash flow, allocation of income, all kinds of things. But that would run afoul of the IRS's argument saying that you really didn't change anything. You really didn't transfer. They retained a life estate in the property. Therefore, this fails. So, yeah, be very careful in structuring it. All right. Well, Jennifer, do we have any questions on chatted in on valuations and the valuation process, or
We
the determination of
do.
discounts? Okay, might be a good time to take those. Yeah.
Yeah. So it says, can LLCs be used for a lack of marketability discount? And how much valuation discount?
Yes, and also depends on the LLC operating agreement, how you want to write that agreement. If you permit the owner or interest holder, the member, to sell the LLC interest to wherever, whoever, yeah, the marketability discount is not going to be much. But if you're putting restrictions, usually they would say, you need to ask the current
Right of
owners
first
and see,
refusal, right of
yeah,
first refusals. Yeah.
right. Yeah, if you have to go through all this and before you can actually go out to sell the interest to someone else, there will be still discount there, but will definitely less if they are really restricted.
So what's interesting, I've been around long enough to have practice when there didn't exist LLCs. And you'll notice by this acronym here, FLP, or Family Limited Partnerships, these were generally set up as limited partnerships because they LLCs weren't available. You could substitute FLP to be FLLC. Same concept. LLCs are these entities that can be treated both as partnerships, that's the default, or they can actually be elected to be treated as corporations. Would not be a good idea in an estate planning to put all your assets into a corporation. Again, reasons beyond the scope of this presentation, but generally speaking, C corporations are probably the most inefficient way to, tax-wise, to operate a business or hold your affairs. So, okay, very good. Any other questions, Jennifer?
Not that I'm seeing that's come through. If anybody does have a question, please go ahead and put them into the Q&A box, or use that little raise hand icon and we can let you ask it live, because we are a small enough group this morning.
Okay. So let's shift the conversation more specifically toward real estate, because again, in my experience, real estate is, the number one, the largest asset of family groups, even when it involves the personal residence. So just as a reminder, there are various forms in which you can own real estate, direct or a fractional interest. Direct ownership of real estate, we're all familiar with. I own the deed as a fee simple. I don't have an entity that I hold that in. That may not be a good idea for limited liability reasons, or maybe even for anonymity reasons. Actually, Carolyn and I just worked on a transaction with a very, very wealthy family. The father just recently bought a home for the daughter, $5 million. He didn't want anybody to know, basically, that he bought the home. She's using it as a personal residence. On the advice of the attorney, we actually set up two LLCs, one that owns the title to the property, and the other is the LLC owns the other LLC, which is owned or managed by the manager of the family office, who actually lives in Morocco. So if somebody really wanted to find out who owned that home, it would almost be impossible. In fact, it would be impossible for them to figure it out. So many times the very, very wealthy individuals, they're not driven by tax reasons, they're more driven by anonymity and limited liability. Another common ownership of real estate is simply, especially in California, community property. I think we have a very narrow view of the rest of the world here in California. There's only, I think, 7 states in the United States that are community property states. And historically, really, that comes from is the influence of the Catholic Church. So, we're bordering Mexico, Catholicism, huge religion of Mexico. A lot of the states adopted the concept that you know, what's my wife's is half of mine, and what's mine is half my wife's, or as I like to say, what's mine is hers, and what's hers is hers. No, I'm just kidding. But anyway, but the rest of the country doesn't operate that way. I mean, there are rules regarding separate property, unless you actually commute that property or agree to commute it. We don't have that concept. So the ownership of community property is very important, because on date of death, remember that stepped up basis that I told you about? Well, if you own property as community property, even though by law your wife is deemed to own half of the community property, when you die, not only is your half of the community stepped up, but her half is as well. So that is a unique concept in community property states, and it's a very important concept, because again, regardless of the $11.7 million exemption that we talked about earlier, any transfers to a spouse, either during life or at death, are free of estate tax, at least on that date. Now, the bad news is now mom, typically mom, dad will be the first one to go. So mom now owns 100% of the property. Now, without proper planning, 100% of that property is included in mom's estate. But at least you are afforded the stepped up basis. One of the things I discovered early on in my career, and I noticed, I put that here as a joint tenancy with right of survivorship. If anything, you walk away from this presentation, you probably should go back and look at how you hold title in your property, because title is very important, and title could actually override any estate planning that you have carefully put in place. And a joint tenancy, so in a situation where I had husband and wife owning property with a joint tenancy as a right to survivorship, on death of the first tenant, there won't be a stepped up basis in the surviving joint tenant's property. So that is a terrible result that could happen if all you simply did was hold it as community property. So I have had situations where I've gone down the road with clients doing estate planning. The first thing the attorney asks is, how do you hold title? Let's make sure that the title is consistent with the estate plan. And then the last two that I kind of skipped over was a single member LLC. Those are actually disregarded for income tax purposes. So if somebody wants to set up, as I mentioned, the wealthy individual, daughter of the wealthy individual holds her personal residence in a single member LLC, that has no tax consequence whatsoever. It's disregarded for tax purposes. It's really almost as if she owns it as her personal residence. It's disregarded. However, the bad news is that as an LLC, you will still have to pay the minimum $800 and be subject to a gross receipts fee with the state of California. So there is a cost associated with setting up these LLCs, not to mention the form that you have to file every year with the Franchise Tax Board. And then lastly, with respect to direct ownership, you have the ability to divvy up interests in real property as an undivided interest. So maybe you're familiar with the term TIC, or tenancy in common. So unmarried couples, this is a very common form of ownership among unmarried or unrelated individuals. So Carolyn, my question to you, taking this back to the discounts or the adjustments that you referred to earlier, do I get an adjustment if I own a direct interest in undivided, a TIC? Does a TIC get an adjustment?
Well, not as much, because a TIC, your tenant still has the right to your property directly. I mean, there might be situations, you could set up agreement with your tenant, but they still have the right to go out and sell the interest, his or her interest, to someone else, right? So you might end up with partnering with someone you don't know or you don't like, who knows? right? So the adjustment for marketability or control both actually would not be as much as a fractional interest in a business entity.
So I guess and actually we skipped the answer to the question posed earlier, just to give us a sense for adjustments. I know you don't like the term discount. What are the range of adjustments that you normally can get? I know it depends on the property type and the restrictions and the agreements, but what are we talking?
Well, for a fractional interest in a entity, in a limited partnership or LLC, typically will run the combined interest around 40, 35 to 40%.
Wow.
It's a combined of control and marketability.
And what if I don't hold it in an entity, I just hold it directly as a TIC interest, not in an entity?
I think typically it's an average at 15 to 20.
15 to 20.
Right.
Yeah. Okay. So if anything, if we were looking to maximize the adjustments on transfers and we wanted to transfer an undivided interest, you might want to consider transferring that interest to a partnership and receive a higher adjustment. Sounds like. So there's a planning opportunity. One of the things that, and I again, time permitting here, I wanted to just caution us that transferring real estate has another implication. It's not only helps you to reduce your estate tax, but you have to worry about whether or not that transfer, either directly or through an entity, will trigger a reassessment for property tax purposes. Now, again, this topic can be, one all of itself. In fact, I borrowed some of these slides from a presentation we'd done a couple of months ago regarding what happened in Prop 19. I don't want to go over all those rules, but I do want to caution you that if you are anticipating taking this advice, setting up fractional interest in either a family limited partnership or a tenancy in common arrangement with family members, and it involves real estate, you do need to be cognizant of these rules. So generally speaking, a transfer of real estate to a family member will generally be a reassessable amount. Okay? You will be subject to reassessment on that transfer if the ownership is more than 50%. Or if the real estate itself is not a personal residence in which the child lives in as their personal residence. So that was a huge change, beginning of this year, February, in Prop 19. Not to say that you can't transfer property fractional interest, but you have to be aware of that 50% limitation. So again, I won't spend a whole bunch of time going through that unless there's questions regarding that. But let me give you a typical example of how you could effectively transfer 100% ownership in real estate and avoid property tax reassessment completely. And that technique uses what's called uses the LLC as a way to transfer that ownership. So here's the scenario. Mom and dad, we can go back to my original example. Let's just say that mom had $12 million worth of real estate, and she wanted to transfer that to her daughter prior to death, but didn't want to trigger a property tax reassessment. She may have bought that property, 15 years ago, 20 years ago, and has a very, very low assessment rate. If she were just to transfer the property to the child, not a principal residence, not living in it, it's going to get stepped up to $12 million. You've just created a huge property tax problem. How do you avoid that? Well, the first step you would do, same as we did in the family limited partnership, transfer that real estate to an LLC. At that moment in time, it would be a single member LLC, owned 100% by mom. Mom would then start to gift those fractional interests in the LLC Now, once she gives an LLC interest, it's no longer a single member LLC, is it? It's now a partnership, okay? Which, by the way, means you're going to have to file a partnership return for the ownership. Okay, can't avoid that. But you will receive those adjustments that Carolyn mentioned on that fractional interest. So let's just say in the first year we transferred 5% or 10% of the LLC interest. Mom owns 90, child owes 10. Maybe we get a 35, 40% discount on that transfer. We eat up part of our 11.7 million exemption, but we didn't eat it up as much as we thought had we given 100% of the property because of the adjustments, right? Now we continue to give those gifts. Oh, and by the way, in addition to giving property and utilizing your unified credit amount, we also have something called the annual gift exclusion. You're all probably familiar with the fact that we can give up to, I believe it's $15,000 a year under the current exemption amount annually and not spend your 11.7 unified credit amount. That's the annual exclusion rule. You can do that per person. So if you had, 4 children, you could do it 4 times 15. Or if you're a married couple, each of you could give your interest. Again, if it was held as community property interest, mom gives $15,000 worth and dad gives $15,000. So really, you've got $30,000 that you can give away every year without eating into your unified credit amount and without the requirement necessarily to file a gift tax return. Now, it might be best practice to do that, especially if you're taking discounts on the transfer. But the point is, early planning, you might be actually, able to effectively transfer ownership of real estate over a period of years and never eat into your unified credit amount. Now, that would be counter to the planning that we're trying to do, because we're trying to use that 11.7 million. So we're actually scrambling, looking for ways to use it, but this would be a good technique. So let me finish this example. So we end up transferring up to 50% of the LLC interest to daughter in my example. What happens then, and by the way, every that transfer, which is cumulative, as long as we don't hit 50% or more than 50%, there is no reassessment with the county assessor, right? That's the beauty of this. But remember, mom's goal was to transfer 100% of the property. What happens if she gives one more interest in the LLC to her daughter? Well, sorry, that triggers reassessment of the property, and not just at the amount that was transferred to the daughter, it reassesses it at 100%. So in this scenario, up to 50%, you're fine. 1 more percent transferred will then trigger the assessment on, in my example, $12 million. How do you avoid that? Well, when you get to the 50% mark, you dissolve the LLC. Now what you've done, and by the way, dissolution of the LLC, transfer of that property out to now the individual partners. At this point, daughter owns 50%, mom owns 50%. We liquidate the LLC, and now mom ends up owning a TIC interest, 50% in the property, and daughter owns 50% TIC interest in the property. Now, mom is free to go ahead and start to gift her TIC interest to anyone she wants, as long as the person that she transfers that next percentage to doesn't control more than 50%. Well, in my example, obviously she gave 1 more percent TIC interest to daughter. That's not going to work, because now daughter ends up with 51%. Okay. Now, at least you won't get a reassessment on 100%. You'll only get reassessed on the 51% that daughter owns, but there's a better way. The better way is that if daughter were married or daughter had children, and she actually gave her TIC interest, either currently or maybe in the past when mom was giving her the LLC interest, to other individuals, Now, when mom makes that ultimate gift to daughter or the other beneficiaries, no one person is getting more than 50% ownership. So that effectively then transfers, and mom could then finish out her gifts, complete 100% transfer of her TIC interest, and as long as at the end of the day, no one person owned more than 50% of that interest, say it was owned, by daughter and daughter's son or daughter's husband, or a trust for the benefit of daughter. You get what I'm getting at. Then you have effectively transferred this property and not triggered reassessment. I'm going to stop there and just ask if there's any questions on that, because I kind of blew through that, but I think it's an important part of this planning.
And Tim, we did get a question that came through earlier
Right.
that was, what is the discount if the real estate is held in a DST?
Well, I'm going to, you can take that person's information and I'm going to put that in the category of that's a really specific thing. And it would take an explanation of what a DST is. So DST is a Delaware statutory trust. And let's take that person's information. I'm happy to answer that offline.
Okay, I'll make sure that Duncan has your information.
Perfect. So just to kind of wrap up, because we've only, I think we're at the time wall here, aren't we, Jennifer?
Yeah, we're just about there. So if we guys have any last minute questions, please go ahead and drop those in the Q&A box. And also save the date for our next webinar in our real estate series. The topic will be announced in a few weeks, but save the date for Thursday, July 22nd at 9 a.m.
And so my closing thoughts would be that if you're talking about estate planning and you're talking about transferring real estate, there are hidden costs, obviously, in the whole estate planning process. Not only, the fees for your attorney to draft the documents, my fees or your accountant's fees, or for helping you navigate this process, but you need to consider the other things that need to be considered, which are transfer taxes, the title insurance. If you're transferring a personal residence and mom and dad or mom is still going to live in that personal residence, you can effectively do that. But in order to respect that as a complete transfer, mom at one point is going to have to pay you rent. So if that's the case, then now you turn what was a principal residence into a rental property. You need to deal with that. You may want to consider buying renter's insurance. If you were to sell the property, you don't have to necessarily gift it. You can also sell to your beneficiaries. That will have income tax consequences. Yeah, it may make sense to do it, but ultimately you have to deal with those formalities, I guess, is the point. This is something that the IRS is going to look very closely at. If you don't maintain the formalities, you got to do what you said you were going to do. So with that, I hope we gave you a taste for, valuations and the valuation process. I hope I made the case for estate planning and the need to do estate planning. Very important, especially if you are looking at an estate that's going to be on an individual more than, I would say, 10 or 11 million dollars in today's value. If that unified credit amount goes down, you are certainly going to be subject potentially to an estate tax. We have a saying in my business that the estate tax is a neglect tax. If you neglect to pay attention to it, you will pay it. All right. So thank you very much. Thank you, Carolyn, for joining us. Appreciate
Tim,
it.
we've got one more. We've got a couple of questions that didn't pop through. Someone's asking about the current status of 1031s and is that changing?
Happy to talk about that. So here we go again. As you know, that in 2017, in the Trump administration, they actually eliminated the ability to transfer personal property. So you no longer can trade your BMW for a new Mercedes and not have a tax consequence as a result of that. Or you can't, trade your Picasso for a Van Gogh, or you can't even trade your baseball contract, I mean, those were all things that 1031 applied not only to real property, but to personal property. So they restricted the ability to transfer personal property pursuant to 1031. They retained the right to do that for real estate. Biden wants to not eliminate 1031, but he wants to curtail the benefit for individuals who have gains of more than $500,000. Now, I'm here to tell you that that is likely to get a lot of opposition. The real estate lobby is huge with respect to 1031s. I'm not to say that it's not going to be curtailed in some fashion, but it will be a debate. And if you are anticipating either selling property or buying property and it makes good economic sense, you better do that sooner rather than later. Not only because of the elimination of 1031 potential or restriction, but because of the increase in capital gains rates. So Biden also, as you probably heard, wants to tax individuals with more than 500,000 of taxable income, or couples with more than $1 million in taxable income at the ordinary income rate for capital gains that exceed $1 million. So we are planning with a lot of clients to accelerate capital gains transactions in 2021 so that we take advantage of the lower capital gains rate.
Okay, and in the last 2 minutes, we have one final question.
Sure.
Have you done the calculation of the capital gains tax versus the estate tax based on the strategy you've presented if the property is sold in the future after the transfer?
Yes, in fact, that is key to the analysis. But let me put that in perspective. So everybody panics when they say, well, gee, I no longer get a stepped up basis if I gift my property away today. And that's the current rule. So again, by my example, if mom were to give away that $12 million property and she only had a basis of 100,000, well, daughter is going to inherit the basis that she had, that mom had, 100,000. When mom dies, there's no step up. But let's put this in perspective. If that property had been included in her estate, as I indicated, that $12 million would have been subject to likely a 40% tax. So you're going to pay 40% in estate tax. What did that save daughter as far as capital gains? Well, if capital gains stay at 20%, you just paid 40 cents to save the daughter 20 cents. Does that make sense? No. Wouldn't you rather not get the capital gain break? In other words, my point is you wouldn't spend 40 cents to save 20 cents. And that's exactly what you're doing if you don't transfer the property today and subject that property and its appreciation to a 40% and possibly a 45% estate tax. So yes, but again, circumstances are different. Planning can be done for individuals. So you want to plan for whether or not hitting that stepped up basis counters your recommendation to transfer the property today. But it's a great question.
Okay, and I think with that, we are done for today. I thank you all for joining us, and you will receive a copy of this recording as well as a copy of the slide deck and the contact information, both for both Tim and Carolyn, for if you have any further questions. Like I said, please save the date for our next real estate series webinar on Thursday, July 22nd at 9 a.m. Have a fantastic day, everybody.
Thank you.